So here as we turn to Europe, you can see some of the different shifts that have happened. So the M3 supply, as you can see, is down, but it's important to look at this chart at the bottom, which, as you can see, the contribution of the M3 counterparts. The issue right now is we had massive influx. Now, as you can see, there was continuous inflow. So we've continuously seen the growth, and then it went on an exponential level, and now it's starting to drift back down, but you had so much get pumped in, it's going to take time to pull it out. And the fact is, there's all these assumptions that it's like, oh, well, we dumped all this money in and it'll just, slowly come out over time. It's like, but we have to go negative for a period to pull this out in a meaningful way. And I think that's the biggest issue is there was never a thought of how do we exit. And I think that's the biggest issue that we have today. There's a chart going around talking about how this was all supply chain driven and it's better. It's like, that's not the case. Is supply chain played a part? I am by no means saying it didn't. But if it was all supply chain, it would already be gone. It's not, and it won't. That's not how this works. The fact that you've had these massive amounts of M3, M2 getting pumped into the system, that is what creates this legacy issue, which is not going away. Now you look at consumer confidence, which is at -16, economic confidence, falling, industrial confidence falling, service confidence falling, while CPI goes up. CPI estimates was expected at 5.1, came in at 5.3. CPI month on month expected at 0.4, came in at 0.6. You're getting a reacceleration as we've been discussing in August, and Europe is just the first one really showing some of these problems. Now, in the U.S., as we've showed before, there was a decent ability to roll debt and get it to the next level. Well, corporates in Europe have not been as lucky, and corporates faced a looming refinancing wall. But it's important to appreciate that they were also financing stuff at negative rates. That's gone. So even the mark to market is massive. Even if you were able to roll, your interest expense is going to go parabolic just because of the inherent shift from negative into positive rates. Higher mortgage costs pass through, which is interesting in terms of the different rates, and you can see that underlying hit where on average the share of variable rate loans and total loans for home purchases is at 23% across the euro area. That's a big number for people to have to eat. Then you look at the loan to business, which is continuing to fall, and the loans to households, which continues to roll over. And you see that continuous impact, which again is not going away. And until and it's not even negative yet. And that's the whole concern when you look at M3, M2, you still have a certain velocity of money. You need to slow this down. And unfortunately, the only way to meaningfully do it is to push rates higher. So Germany gave us our first bridge in terms of where we are. Private consumption, as you can see, was initially at 0.2, is at flat. Capital investment was initially -5, came in at 4. -0.5 came in at +0.4. GDP quarter over quarter was flat. When you look at year on year, -0.6, -0.2, so right in line with where Q2 was. Business climate was expected at 86.8, came in at 85.7. Current assessment slightly below estimates at 89. Expectations came in at 82.6. So you get that cascading problem with which it was starting to get better, and now it's rolling back over. Consumer confidence coming at -25.5 versus the estimate of -24.5. So again, another step down. Import prices have gotten better. That's a little bit of deflation that's going to be pulled in. But CPI there's other issues. And this is what we keep talking about. There's other problems that are monetary based, not just price based. There's a mixture. It's a blend of the two. But when you look at CPI, it came in at 0.3. You look at year over year, it came in at 6.1. Month on month came in at 0.4 on a harmonized level. So you're actually seeing, we stopped seeing it come down. And that's why we called BS on some of the ECB expectations that, you were going to have this massive drop in inflation. And it's just, that's not what we're seeing. That's not what the leading indicators are saying. That's not how inflation has worked in the past. So, and here it is where you, even as you have easier comps, which are starting to fade, and as those comps fade away and the comps get harder, you're going to see that stickiness. And then you look at retail sales, expected to be at 0.3, came in at negative 0.8. So the consumer is inherently slowing. Manufacturing, this is what we've been saying, manufacturing was going to come down, it's going to stay down. It's the service side, it's the consumer that is that last shoe to drop. And those retail sales, I think, are showing what's coming, which is why when you look at the IFO numbers based on manufacturing, trade, service, construction, you're seeing that general trend continue to move lower, especially when you look at the service sector as those expectations look negative, construction, trade, and then on the manufacturing front. So then when you put the wage side, well, record wage growth has caught up with inflation, which is good on one side, but a problem on the other, because that's also going to keep some of that stickiness in the inflation front. German GDP and IFO current conditions continue to roll over, again, showing some of that additional slowdown. France, business confidence, manufacturing confidence, production outlook, all moving down. Production outlook, -9. Consumer confidence in line, but then CPI actually increased, and meaningfully. CPI month over month was expected at 0.8, came in at 1%. Year on year, expected at 4.6, came in at 4.8%. So when you look at this acceleration, it's a problem, and it's based on energy costs, based on where things are. It's not going to get better. PPI did improve slightly, came in at -0.2, but PPI year on year still at 0.9 and accelerating a bit higher, which is where we see some of these underlying problems continue. Italy, kind of flattish when you look at some of the expectations, but then on the CPI level, it came in at 0.2. So again, kind of a mixed bag. Industrial sales slowing, still positive, but slowing. And we expect to see that continuing to ramp up into next year. Spain PPI is on the other side of this. They actually saw it reaccelerate. Retail sales were slightly better. And then at the same time, when you look at CPI, expected to be at 0.5, came in at 0.5. Total mortgage lending came in at -16%. House mortgage approvals came in at -21.9%. So housing is slowing as you see, again, that pivot back up in CPI. And this is already August, so this is showing what is going, but all the leading indicators still show that it's accelerating a bit into September. Now, September won't be as strong as August, so you will get a little bit of that benefit, but it's still elevated. And that's why we see, again, more rate hikes and more pressure that's still yet to come. So that's what we have for you on Europe. In the next segment, we're going to go deeper into China, some of the ongoing issues there, and how that's going to continue to progress.